Hello everybody, I am Harsh Avasthi, Assistant Professor, Department of Management Studies, NIET Greater Noida. Today we will discuss about corporate valuation models. When we fall into the business, either in a running course of business or we establish a business, we need to identify its value. Value is something which is going to define the future course of action, whether I should be proceeding with it or I should be stopping it here only. In a real practice, the corporations are having the perspectives to demonstrate into the economic atmosphere. How we can go with those perspectives in line with the valuation, that would be discussed here. So, valuation, if we talk about, is something determining the economic value of a company. Economic value is related to the money, economy. We can talk about funds, we can talk about cash, but what is the actual value which is going to be derived at the time by the people who are going to evaluate it? What methodology is going to be used is going to affect the value of the company. So, whenever the organization moves for its valuation or an analyst moves for the valuation of any organization, certain perspectives, certain key points are needed to be kept into the mind. So, we can talk about certain key facts of the valuation, that is, price is not same as the value. Price is something which is a consideration of a transaction. Value is not a transaction. Value could be abstract. Value could be at a given point of time. As the second point is saying that value varies with purpose, person and time. What is my purpose? Whether I am going to follow a regulatory compliance for the valuation, then my purpose would be following a particular methodology of valuation which has been told to me. Purpose, that is the purpose. Person, who is going to analyze the value of the organization and ultimately at what time? If I am eager to sell my business, perhaps I would be selling my business at a lesser price. But if I am eager to buy any business, perhaps the person who is going to sell me would be selling at a higher price. Then last is the standard and premise of valuation. What basically I am going to select as a standard and what is the premise of my valuation, we also have to go with this. So, proceeding with the presentation, we will discuss about certain corporate valuation models, out of which a select few: asset based valuation model, earning based valuation model, cash flow based valuation model. Then we will go with the capital asset pricing model. Next would be the arbitrage pricing theory, and lastly we will talk about the economic value added, that is known as EVA analysis. So, proceeding with the asset valuation model. Asset valuation model is related to the company's net asset value, and net asset value is identified by subtracting the total liabilities from the total assets. When we talk about the assets and the liabilities, we can categorize them. For example, if I talk about the assets, I could be finding out certain tangible assets and certain intangible assets. Now, what is going to be my consideration? Whether I am going to include or exclude tangibles or intangibles, this is needed to be understood very clearly by the analyst at the time of valuation. So, as it is written here, net asset value is equal to total assets minus total liabilities, then company's assets and liabilities to include in the valuation. Which of the assets are going to be included? Whether I have to go with the tangibles one, the land, building, machinery, equipment, then I come to my intangible assets. Those are goodwill, trademarks, copyrights, patents, IPRs. How I am going to value them? How I am going to put a check on them whether they should be included or they should be excluded? because the value of those intangible assets could be substantially high or substantially low as per my consideration. and which could be very much dependent on the market conditions also. When we follow the asset based valuation model, there are two approaches. One is the going concern approach and another is the liquidation approach. Going concern and the liquidation one. Going concern approach is going with the intangible assets included when we are going to find out the net asset value of any company. So, I am going to include the value of all the intangible assets into my total assets, and then I am going to subtract my liabilities to reach to that net asset value. Second is the liquidation value approach. Liquidation is the last process in the company when company is going to be liquidized by will or by force. So, it is a closing value. Whatever value is there of the assets and the liabilities, that is going to be taken into the consideration. So, that is all about the asset based valuation model. Next, we talk about the earnings based valuation model. Earning based valuation model says that actual value of a business lies in the ability to produce revenue in the future. Whenever a businessman is going to establish a business, coming up with an idea to get it commercialized, obviously there is certain intention of earning the profit. When we go with the financial management premise, we have studied about the profit maximization on one hand, and on another hand we have talked about the shareholders or stakeholders wealth maximization. So, stakeholders wealth maximization is, yes, that is acceptable, that should be there, but when I am going to put my energy, my resources, my capital, my intellectual property into an idea to get it commercialized, obviously I would be expecting certain amount of profit out of that. So, this is needed to be understood. So, what we are going to do here, that we are going to capitalize the earnings, and whatever earnings are going to be capitalized in the future course of action, then we are going to calculate its net present value. We are going to discount it to the present time. What would be the future earnings? Because there is risk in the market, there are uncertainties in the market. We have to go against those uncertainties and the risks. We would try our maximum to eliminate those risks, to eliminate those uncertainties, so that at least I can reach to a fair value on the present time basis, which is going to be a benchmark or a decision rule for my further decision. So, what we are going to do here, that when we are going to discount the future earnings of the company at a real time, at the present time, then we are going to divide it by the capitalization rate. Now, what is this capitalization rate? Capitalization rate is obtained by dividing the operating income from the purchase price. Normally, we are going to accept a capitalization rate of 20 to 25%, but this cannot be set as a standard rule, because dependent on different micro and macro variables, that could be getting changed, that could be getting varied. So, this is basically the earning based valuation model, where we are going to capitalize the earnings in the future course of action, and then we are going to put them converted into the present time, so that we can actually find out the real essence out of those earnings. Moving further with the cash flow based model. As earlier we talked about, it is a bit different from that. Based on present value of operating cash flow after deducting the capital expenditures. What we are doing here? We are going to talk about the operating cash flow, and then we are going to deduct the capexes, capital expenditures, because they are the cost for the assets, they are the prices for the assets. We have to subtract them to find out the real operating cash flow, which is the OCF, out of any business transaction, out of any commercial activity. So, in the formula you can see here OCF, which is the operating cash flow, is equal to EBIT, earnings before interest and tax, multiplied by 1 minus T plus D, D is the depreciation, minus capex, minus D multiplied by working capital, then less that depreciation on any of the asset, whatsoever asset is there. It does not make any sense कि एक asset है, दो asset है, तीन asset है. No, any of the assets are there, we are going to subtract the depreciation value of those assets. What actually the difference is here, previously we were talking about the capitalization of earnings. Earnings are not equal to the cash. Profit is not equal to the cash. Profit is different, cash is altogether different. Profit might not be getting converted into the cash. We have to take care of it. Because if I am going to make a sale, if it's cash sale, I am going to collect the cash amount instantly. But if it's a credit sale, I am going to witness the debtor, and if that debtor does not turn up, then it's going to be a bad debt and ultimately turning into a loss. So, this is needed to be understood. Credit sale is also going to accrue the profit, but that profit is not going to be realized. From that perspective, we also have to make a very clear distinction. Being an analyst, we have to keep a very clear distinction in our mind that capitalization of earnings is altogether different to adopt a different methodology in case of the operating cash flow. Proceeding further with the capital asset pricing model, CAPM. It is a very popular model, very easy model to understand, very elementary model to understand the return from any asset or expected return from any security, stocks, investments. It is going to talk about three parameters: risk-free rate, market return and market risk. Based on these three parameters, I am going to analyze, I am going to calculate my expected return. So, as this formula is telling about R is equal to RF plus beta multiplied by RM minus RF. This RM minus RF is the market risk premium. RF is the risk free rate, the rate of interest, the rate of earning which could be earned without any risk. In India, we treat the treasury bills as a risk free security. Now, by investing in the treasury bills without any risk, I can earn money. There is no risk, there is a risk free rate. But if apart from that, a bit of my earnings, a bit of my investment, I am willing to make into some market portfolio where there is risk, and following the premise, more the risk, more the premium, could I not be getting the premium out of that when I am going to face the risk? Obviously, it's expected. जब मैं risk लूँगा तो उसका premium भी expect करूँगा. So, RM minus RF, RM is the market return, RF is the risk free rate common है, it can be obtained without any effort, without any analysis. So, premium is the difference between the market return as well as the risk free rate. Very elementary formula, very simple to calculate and gives you the value on an on hands basis in very simple approaches. And beta is there, the market risk coefficient. So, whatever market risk is there, we are going to multiply the market risk premium with the beta to find out its coefficient value, and then we are going to add it into the risk free rate. That is all it goes. So, what is there? First is the risk free rate, which is available to all. This is something market risk which is available or which is going to be identified, which is going to be collected out of certain risk, and this RF is the risk free rate again. So, this RM minus RF is equal to market risk premium multiplied by this beta and added into the risk free rate gives me my total expected return from an asset or a stock or a security. Now, we will talk about the arbitrage pricing theory. It is basically a multi-factor asset pricing model. When we talk about valuation, we are going to consider the micro variables as well as the macro variables. Macro variables are related to the entire economy, the societal environment, where we can be finding out pestle, political, economical, sociological, technological, ecological and legal forces. These are the macroeconomic factors basically. These are the macro factors which are going to affect the entire task environment of the industry, obviously the industry. So, whatever macroeconomic factors are there which are going to make an impact on my valuation, on my methodology, on the value of my company, I have to consider them. I have to take care of them because they are going to make a substantial impact on the valuation of the company. So, it is a multi-factor asset model where we are going to apply the linear relationship between the expected return of a macroeconomic variable that captures a systematic risk. Now, here comes the systematic risk. Systematic risk is that risk which cannot be tolerated. If it is unsystematic, I can tolerate it with the help of diversification, but this fellow cannot be tolerated because it is coming into a system. It is like a tax. If someone is salaried and falling into a tax slab, then that fellow has to pay a tax. Whatever deductions are there, whatever tax avoidances are there, that could be done, tax planning can be done, but after that if certain amount of income is falling into the tax slab, then you have to pay the tax amount. That is it, that is the systematic one. So, when we talk about the macroeconomic variables and the systematic risk associated with them, we have to make a very clear understanding that systematic risk cannot be tolerated by way of diversification or by any other methodology. It would be having its impact on the company valuation. So, we have to adjust that, and what we are doing here, that we are going to adopt a linear programming model, very simple linear programming model. So, again the formula talks about ERI is the expected return. Then we are going to talk about the RF, which is the risk free rate of the return, which could be easily observed, which could be observed by everybody. Then beta, sensitivity of the asset out of that systematic risk. Whatever asset is there, whatever resource is there, which is going to be affected by the systematic risk of any macroeconomic variable, that could be inflation, that could be increase in the demand, that could be change in the supply conditions. Many of the macroeconomic variables could be there. So, we have to understand that what is the sensitivity of that macroeconomic variable, what systematic risk it's posing on the assets of the company, on the company's value, we have to accommodate that, we have to work it out. So, RF plus beta I1 multiplied by RP1 plus beta I2 multiplied by RP2, beta multiplied by Kn multiplied by Rpn. So, what I am doing here basically, I am going to find out the sensitivity of my investments, and then I am going to add the value of my risk premium for a specified factor and up to the nth factor. And when I am going to add it in a continuation basis up to the nth term, I am going to find out my expected rate of return. Now, lastly we come to the EVA analysis. EVA stands for economic value added. So, EVA as it is written here is a measure of company's financial performance based on the residual wealth. Now, two things, financial performance based on residual wealth जो बचा हुआ है, calculated by deducting its cost of capital from its operating profit. थोड़ा सा गणित है यहाँ पर। Financial performance based on the residual wealth calculated by deducting its cost of capital from its operating profit and adjusted for taxes on a cash basis. 5 things are there. Financial performance. So, how to understand the financial performance? Whether financial performance is going to be taken as the financial soundness, whether it is the liquidity, whether it is the profitability, whether it is the operating efficiency, whether it is the capacity of the company to turn its profits into the cashes, whether it is the ability of the company to turn its debtors into the cash, whether it is about turning the inventory into the finished goods. So, number of aspects are there which could be related to the financial performance directly or indirectly. This we have to think as an analyst. It is not only that only financial parameters are going to affect the financial performance of the company. Yes, they are going to affect directly, but indirectly number of parameters are there which are also responsible for the financial performance of company, because their output is going to be converted into the terms of financial value. We try to convert a transaction, we try to find out a transaction, or we try to convert a transaction into a financial value, into a monetary value. And for the accounting purpose, if I talk about, if I cannot convert a business transaction into a monetary value, that business transaction cannot be posted into my books of entry, because accounting is talking about the monetary value of the transaction. Second point is the residual wealth, whatever has been left. अब जो बचा है मेरे पास, calculated by, now note this point, deducting its cost of capital. Cost of capital is the cost which is incurred by the business to raise that capital, be it the debt, be it the equity. In case of equity, cost of capital could be the amount of dividends paid, that could be equal to the retained earnings, cost of retained earnings. When we talk about the debt, in case of debt, it could be the interest, what I have to repay with my EMI as the integration of the principal amount as well as the interest amount. So, residual wealth calculated by deducting its cost of capital from its operating profit. Whatever profit has been going to be fetched by the operations of the business, operating activity of the business, that is needed to be understood and adjusted for taxes on the cash basis. So, 5 parameters are there. It is going to measure the financial performance based on the residual wealth. So, first is the financial performance. We have to identify the factors which are going to affect the financial performance. Based on the residual wealth, whatever wealth has been now left with the company, calculated by deducting its cost of capital from its operating profit. So, we are going to deduct the cost of capital from the operating profit which has been observed out of the operations of the business firm, and then it is going to be adjusted for taxes on a cash basis. Cash के basis पर हम taxes को adjust करेंगे. So, it is used to measure the value of a company generates from funds invested in it. So, what value the company can generate out of the funds which have been invested, that is needed to be understood. So, let us see this formula. EVA, economic value added, is equal to NOPAT, NOPAT, net operating profit after tax, less, now subtract invested capital multiplied by WACC, weighted average cost of capital. Very simple decision rule is going to be applied here, that when I am going to calculate my economic value added, then by subtracting the invested capital multiplied by the weighted average cost of capital from the Net operating profit after taxes, as I told, taxes adjusted on the cash basis. Then either I would be getting a positive value or a negative value. So, if I am getting a negative value, means negative economic value added, it means there is no value from the invested funds, there is no any value generation. But if economic value added is positive, it is a positive figure, it means value is being generated by the invested funds. So, decision rule goes to be whether the EVA, economic value added, is positive or the economic value added is negative. So, that is all about today's discussion of the corporate valuation models.